U.S. stocks ended today lower, as the Fed is hinting that maybe they're going to do something stupid, in my mind, to prove a point. The S&P 500 now back in the red for the year. My next guest, though, says the economy is humming along, but doesn't need to be knocked down a peg or even two pegs. Joining me now, Peter Morici. Dr. Morici, you know, you've been pretty positive about the overall economy. Looking through those Fed minutes that really gave Wall Street the jitters, they're sort of obviously pretty excited about this economy as well. But are we doing so good? Is the economy so robust that it's time to start hiking rates?
Well, the Fed's in a tough spot. Remember, it has to target inflation as well as unemployment, so to speak. And inflation has been heating up. And the latest CPI report was rather disturbing. So I think they've got their eye on that. Economic prospects are improving in Japan, in Europe, so that should help corporate profitability in the second and third quarters. The translation on exchange rates should be more favorable than it was last year. So, you know, they're looking at those kinds of things as well. A quarter point in June and a quarter point in December should hardly be enough to tank the stock market. What really matters is how much the economy recovers and how much corporate profits improve.
Well, and I think to that point, if we look at the consumer price index, crude oil, gasoline, that sharp rebound is reflected in it. If you take that out, it's hard to find inflation. Apparel is down, used cars are down, new cars are down. The large chunks of this economy, outside of healthcare, they're all sort of drifting a little bit. And then if you look at the stock market and these corporate earnings, Peter, the best earnings came from the cheap discounter Walmart. Everyone else is getting hammered.
Well, certainly corporate earnings have been trending down, and it hasn't been favorable at all. Inflation, if you pull out energy, has been around a little bit better than 2% for several months now. That's what's concerning them. And also, as energy prices go up, not only does the energy component go up, but it starts to filter through into other aspects of the core because people use energy and raise prices. So I think they're looking at that. Now, I don't think they can be blamed for looking at that.
So would you be surprised, or would it be justified in your mind to go as soon as next month? Or should they wait, particularly with the UK vote on perhaps leaving the EU?
I don't think the UK vote on leaving the EU is all that relevant because I don't think they're going to leave. I think it's justifiable to raise interest rates in June and then again in December. I would advocate a different track, of very small rate increases at each meeting, like 1/8 of a point or something, and just tell Wall Street, this is what's going to happen. These rates aren't so terribly high that you can't live with them.
So spoon feed the whining babies on Wall Street.
Well, if they're going to whine like babies, then you take out the baby spoon.
If we see a script, though, or a scenario where they do say, hey, you know what, 25 basis points in June, and the market tanks on that news, would it be wise for investors not to panic and perhaps even start to consider about buying some bargains?
I would say that would be a very smart thing to do. Corporate profits are going to start improving in the second half of the year, maybe sooner than that, maybe in the second quarter. And when that happens, the market will recover. Because at the end of the day, that's why we buy stocks, not because of what the Federal Reserve does, but because of what corporate profits do. The economy should be doing a lot better. And by the way, raising the rate 1/4 of a point is hardly going to affect how many mortgages are let, how much investment goes on, or anything like that.
Hey, real quick, Peter, before we wrap this up, if it's proven that the Egyptian airplane crash was an act of terror, does that do anything to your economic models at all?
I think it creates more uncertainty on Wall Street, and I think we're going to have to look at how the public reacts. If it causes a rush to Trump, you know, remember when Ross Perot dropped out of the race, when Clinton ran the first time, Bill Clinton, all of a sudden he surged ahead. Bush was shocked. That could be the jolt that jumps Trump ahead of Clinton and Clinton for good. If that happens, watch for Wall Street to then assess what Trump's about. And they may find that assessment to be much more favorable than the establishment is telling them. He wants to cut taxes and all the rest. It's going to be good.
All right. Thank you a lot, Peter. Really appreciate it.